In this exercise, we're going to prepare and compare income statements using full absorption costing and variable costing. Recall, full absorption costing is GAAP-based and treats fixed manufacturing overhead as a product cost, while under variable costing, fixed manufacturing cost overhead goes directly to the income statement. Let's go ahead. The Fletcher Company manufactures and sells one product. The following information pertains to each of the company's first 2 years of operations. We're told that direct material costs are $20 per unit, direct labor costs are $12 per unit, and variable manufacturing overhead is $4 per unit, which means our total variable manufacturing cost is $36 per unit. We're told our variable selling and administrative costs are $3 per unit, and that we have fixed manufacturing overhead of $200,000 and fixed selling and administrative cost of $80,000 per year. During our first year of operations, Fletcher produced 50,000 units and sold 40,000 units. During the second year of operation, it produced 40,000 units and sold 50,000 units, and our average selling price is $50 per unit. Let's begin by taking a look at our unit calculations, which will be the same under both full absorption and variable costing. Since this is our first year in business, our beginning inventory is 0. If we produced 50,000 units and sold 40,000 units, this means our ending inventory will be 10,000 units. Year 1 ending inventory, of course, is year 2's beginning inventory. And if we have 10,000, we produce 40 and sell 50. This means our ending inventory will be in year 2 will be 0. Let's go ahead now and take a look at our income statements for year 1 and year 2 under GAAP or full absorption costing, which treats fixed manufacturing overhead as a product cost. Our total manufacturing cost in year 1 will be our variable cost per unit times the unit produced, or $36 per unit times the 50,000, plus the 200,000 in fixed manufacturing overhead for a total cost of $2 million. If we divide the 2 million by the 40,000 units, or rather the 50,000 units we produce, we get an average cost per unit of $40. So again, that's the 2 million in cost divided by the 50,000 units we produced. Since our ending inventory consisted of 10,000 units, the value of that ending inventory will be $400,000. That's 10,000 units times $40 per unit. And our total cost of goods sold will be $1,600,000. That's the 40,000 units we sell times our $40 average cost per unit. Moving on then to our income statement, we're told that sales in the first year were 40,000 units. 40,000 units times the selling price of $50 per unit gives us $2 million in revenues. Our cost of goods sold is again simply our $40 average cost per unit times the 40,000 units we sold, or $1.6 million. Our gross margin then is our sales of $2 million minus the $1.6 million in cost of goods sold, or $400,000. We subtract from that our selling expense, which are $200,000. That's the $3 per unit variable cost times the 40,000 units, plus the 80,000 in fixed selling cost. This gives us a year 1 net operating income of $200,000. Year 2, our total manufacturing cost will be slightly higher because in year 2, or rather be slightly lower because in year 2 we only produced 40,000 units, and 40,000 times 36 gives us our variable component, and we add to that the 200,000 in fixed manufacturing to get a total manufacturing cost in year 2 of $1,640,000. We divide this, of course, by the number of units we produced, which was 40, and we get an average cost per unit of $41 per unit. In year 2, we have no ending inventory, so the value, of course, is 0, and our cost of goods sold will need to be calculated slightly differently. We're going to take our calculate our cost of goods sold as the sum of prior year's ending inventory, which was $400,000, plus the current year's manufacturing cost of $1,640,000. Our sales then will be $2,500,000, which is the 50,000 units times $50 per unit. Our year 2 cost of goods sold we calculated above, and again that was prior year's ending inventory value of $400,000 because we've sold all of our inventory, plus the current year's manufacturing cost of $1,640,000. So our total cost of goods sold in year 2 is $2,040,000. Our gross margin then is $460,000. Our selling expenses are $230,000. That's the 50,000 units we sold times a $3 per unit variable cost, plus the $80,000 in fixed selling cost, which gives us our year 2 net operating income of $230,000. That's our gross margin minus our selling expenses. Before we can calculate our total combined 2-year income and compare it with our variable costing, we're going to go ahead and calculate our net operating income each year for year 1 and 2 under variable costing. Our average cost per unit in variable costing is simply our $36, which is our variable manufacturing cost, because recall our fixed manufacturing cost of $200,000 in fixed manufacturing overhead goes straight to the income statement as part of cost of goods sold. Our ending inventory, again, consisted of 10,000 units, so the value of ending inventory is $360,000, which means our cost of goods sold is $1,440,000, at least the variable component is, which is our 40,000 units we sold times the $36 per unit variable manufacturing cost. And again, this is only the variable portion of cost of goods sold. On our income statement, we'll pick up the additional $200,000 in fixed manufacturing overhead. Our sales, like year 1, 40,000 units times $50 per unit, $2 million. Our total cost of goods sold now is $1,640,000. Again, that's the variable manufacturing cost of $1,440,000 plus the $200,000 in fixed manufacturing overhead. Again, in variable costing, fixed manufacturing overhead goes straight to the income statement. Our gross margin then in year 1 is $360,000. We will subtract from that our selling expenses, which again are $200,000, just under the same as in our GAAP or full absorption costing. That's 40,000 units times $3 per unit plus the $80,000 in fixed selling and admin cost, giving us a net operating income of $160,000. Year 2, our average cost per unit remains $36. Our ending inventory was 0, so the value of an ending inventory is also 0. Our cost of goods sold on a variable cost basis is $1,800,000. That's the 50,000 units we sold times $36 per unit. And again, that's the variable portion only. On our income statement, we'll have to add to that the fixed manufacturing overhead. Sales for year 2, $2,500,000. That's 50,000 units times $50 per unit. Cost of goods sold, $2 million. Again, that's the $1,800,000 in variable cost plus our fixed manufacturing overhead of $200,000. This gives us a $500,000 gross margin. Our selling expenses are just the same as in year 2 for the GAAP or full absorption costing, $230,000. That's 50,000 units times $3 per unit for variable, plus the $80,000 in fixed, giving us a net operating income of $270,000. Let's go ahead now and calculate our combined 2-year net income under GAAP, full absorption accounting, and variable costing. Year 1, our 2-year total net operating income under GAAP is $430,000, and it is the same under variable costing. And notice the individual components, cost of goods sold, as well as our gross margin are the same for the combined 2-year period. This is because over the 2-year period we produced an identical number of units and sold an identical number of units under both GAAP and full absorption costing. The difference is in the timing of when our costs flow to the income statement. In the first year, under GAAP full absorption costing, we had an ending inventory value of $400,000. Under variable costing, it was only $360,000. Our assets were higher under full absorption costing by $40,000. Recall, our fixed manufacturing overhead was $200,000, and if we spread this over 50,000 units we produced, the fixed manufacturing overhead cost per unit was $4 per unit. And under full absorption costing, we put $4 per unit times 10,000 units into our ending inventory, where under variable costing, the entire $200,000 flowed directly to cost of goods sold. And we can see that cost of goods sold is higher under variable costing in year 1 by $40,000, which of course results in $40,000 higher net operating income under GAAP-based accounting. This keeps our accounting equation in balance. The higher asset value, inventory value of $40,000 is offset by higher net income, which translates into higher retained earnings of $40,000 as well. Of course, this additional $40,000 value associated with our inventory flows through to the income statement in year 2, since in year 2 we have no inventory left on hand. And we can see our year 2 GAAP or full absorption income statement has $2,040,000 in cost of goods sold, compared to only $2 million in cost of goods sold under variable costing. So our treatment of fixed cost under full absorption costing, we capitalize or record as part of an asset fixed manufacturing overhead, which increases inventory values and lowers costs, but in the long run these costs will flow through in later years to the income statement in full absorption accounting.